back on the financial crisis, how did it change your thinking about risk?
Well, it changed it dramatically. I was head of risk at Credit Suisse in 2008. And I would guess the events of 2008 are a little bit like when you see those steam pipe explosions in New York, and all of a sudden you can see all the wires and pipes and so forth that make the city go. All of a sudden, all that infrastructure is visible. And some of it was working and some of it was not fit for purpose, even some markets that had been around for 2 decades. So it completely changed my perspective on what was successful because it was conventional and what was successful because it was built right. I think it also changed a lot of people's opinion about how much risk was in the system. I think we had done a very good job of managing day-to-day risk and building systems to manage the risk that we were experienced with, but we hadn't done nearly as much thinking as we should have, partly because of the pretty good previous 50 years in what deep risk looked like. We hadn't had that kind of severe crisis in an awfully long time. So it completely changed my notions of what we need to have as big pillars of the system, what should be made to work and what shouldn't. One last point. A place that I was particularly focused on was too big to fail. I had thought we had better contingency plans, but I'm on the outside. I'm a private sector person, not a public sector person. And I would have assumed there'd be better contingency plans. And one of the revelations of Lehman weekend was, no, there weren't. And we all had to learn that, and we all had to get hard at work to build something a lot better.
Before that weekend, did it occur to you that one bank going down could take down the whole system?
It was certainly something that we worried about banks going down. I did not expect the severity and the speed of Lehman's fall. So for example, we knew Lehman was an aggressive actor in the markets. We knew they had some positions that probably they weren't that happy about from a valuation perspective. There have been discussions publicly about a so-called SpinCo, which I think most markets participants would have thought would have some embedded losses in the order of possibly even 10, 20 billion. But on the day of default, the value of their cap structure dropped by over $100 billion. So the severity and the harshness of what happened to that organization afterwards was a surprise. I knew it was going to be bad. I didn't think it would be that bad. I think, in fact, I believe Ben Bernanke had a quote saying, we thought it would be an 8 on the Richter scale. It turned out to be an 11. So I think, unfortunately, we all had to learn something about that.
Yeah, certainly. So reflecting on everything that's happened since in terms of regulation, what post-crisis policies do you think have been most effective at reducing risk to the financial system, and what have made it worse?
So I think we have a tremendous amount more knowledge of what's going on in individual banks, and I'd say things like SeeCAR have forced banks to develop a much bigger architecture. And so SeeCAR is basically the U.S. annual stress tests, and there are versions of this that also exist in Europe. But it's a heavy, data-intensive, very granular exercise, and it forces banks to look at very severe shocks, develop thinking about what they do with their capital structure, and to build enough risk architecture to support that. So I think that's been a good thing. A concern I have that we talked about just now in one of the panels is although that infrastructure and that risk architecture is all to the good, SeeCAR is now a gating capital constraint for most of the financial industry. So it's going to tend to herd banks, I think, to being more looking like each other, and they're going to take risk management processes and force people's brains to be thinking more similarly. And I think that
is this both in the capital they're holding and the type of capital they're holding, both?
Yes, and also their approach to risk and their approach to business model. So that kind of herding and that narrowing of imagination, I think is adverse for the industry, puts a lot more pressure on the Fed to make sure they get everything right. And they have a lot of responsibilities already. I worry that that is a burden. That gets me into some of the notions of the extra resources that the government has tried to force the financial industry to build up. Clearly, the financial industry was light on capital, light on liquidity, light on preparation. And we've built requirements that push all of those up hugely. The challenge is, how are we going to look at that dynamically? What happens when the next recession hits? Because we now have a relatively thin margin between where banks are and where they're required to be, that degree of flexibility to absorb shocks, to treat buffers as real buffers, is limited. One regulator at the Bank of England described these as sometimes acting like concrete airbags. So a buffer that doesn't give you a whole lot of comfort if in fact there's a car crash for the economy. So I worry about that. I would say one unmitigated success, I think, is resolution policy. Ben Bernanke described too big to fail as the central lesson of the crisis. And I think actually we've had unsung and remarkable success in that front. I think that we now have a solution that can work in the US, I think will work in the US, in the UK and Switzerland, and a lot of parts of Europe. Italy remains a little bit of its own rich exception, largely through their own interests. But I'd say in the countries that are forward-thinking and I think tough-minded about making sure that banks aren't too big to fail, we have the technology and we've put the resources in place to solve that problem, and that's a huge benefit.
You also mentioned that the power to be a lender of last resort has been weakened. How so?
So Tim Geithner has spoken on this extensively, particularly around the 10th anniversary of Lehman Brothers, that in the Dodd-Frank Act, that the Federal Reserve's ability to act as a lender of last resort to an individual firm has been deeply curbed. So some of the things they use to solve fast-moving, acute problems would be legally difficult or impossible to do today. To me, it's a very strange thing that I think, although it was a very hard job, Tim, Ben Bernanke, Hank Paulson worked incredibly hard and incredibly effectively to try and contain this brush fire and to get the U.S. economy back on the rails, which actually we did better than many countries. Even though it was a tough recession and politically toxic, I think we did a good job at that. But despite the fact that we used that to help the economy get out of its slump and move more quickly than other people, a lot of the tools they used have been taken away. So a little bit we've said, it was great we had firemen and fire trucks to deal with that problem, but we're not going to put gas in the fire trucks right now. We're going to kind of chain them to the station. And maybe we'll release them in the next crisis, but it's going to be a lot harder to use and a lot harder to act quickly.
So it's not only that banks wouldn't take money if they need it from lender of last resort, it's that it can't even be extended to them.
Right, so you bring up two important points. One is the supply side, can the Fed act? And there are now much more restrictions on what they can do than before, particularly for individual firms. The second question is something that people call the stigma problem, that if the Fed offers liquidity, will you take it, or would you say, no, I'm fine, maybe somebody else needs it, but not me? And that was a big issue in getting banks to participate in federal programs in 08 and 09. I think that does remain an issue. I think regulators are surprised at how powerful that was in a market that was looking for clues as to who's healthy and who's sick. Stigma was a very important thing for many managements. And so finding ways to solve that problem, I think are important. And I don't know if we've made enough progress on that.
So I remember talking to one bank CEO around 2009, and he said that he took federal money anyway. He didn't need it just to get around the stigma problem. But given that they all got kind of sort of painted as reckless for taking money, do you think a bank CEO would take, if Jay Powell sat them down and said, listen, you all have to take a bailout so you don't stigmatize one, do you think they'd agree today to do that after what happened?
So it's a great question. I think even at the time, they knew that. On the other hand, I think there was enough national pressure and a lack of alternatives to get that done. Would bank CEOs react harder today? In some ways, I don't know if it'd be much different for the CEOs of the strong banks. I think that there's a point at which national security issues and financial integrity issues probably overwhelm most. particularly for highly regulated institutions. The question to me is, a problem with a convoy system like that is you don't differentiate between who was good pre-crisis and who was doing the dumb stuff. And I do think now one of the advantages we have with the resolution system is you have an alternative. You don't have to force everybody to move at exactly the same place. You can force some people to use, potentially to fail, and use their bail-in money, their TLAC, to refloat them to protect their real economic functions without taking government money. You could force capital exchanges, and you could probably run an ad hoc stress test much more quickly now so that you could differentiate between who really needs it and who doesn't. But it's a big question that you're asking because stigma is a big issue, but also you don't want to you don't want to put the virtuous in jail with the bad actors. You do want there to be some differentiation so there's some reward for the people that were trying not to get in as much trouble. And I think now there actually are some tools to do that. What I don't know is has there been enough policy planning to know how to do that quickly.
So on Too Big to Fail, I mean, assessing the progress that's been made there, you mentioned better resolutions, and people talk a lot about we've got more capital buffers than we did before. But at the same time, the financial industry has also become much more concentrated, with bigger banks dominating even more. I mean, can we ever really get rid of Too Big to Fail when the market has just a few large players?
Yep.
How?
So Too Big to Fail is, there's sort of two parts to that. One is, how big is too big? And then the second question is, can they fail safely? So yeah, we have some big banks. Actually, as a percentage of our economy, the U.S. is actually not, we're not in the first league there. There are other countries that are much more concentrated than we are. You look at Canada, you look at France, much more dominated by a few big banks. We still have thousands and thousands of banks in this country. Compared to many industries, it's actually pretty dispersed. But we do have banks that are large enough, multi-trillion-dollar banks, that if they failed like Lehman failed, it would be a disaster. So that gets you to the second question. Do you have a system that allows a bank to fail safely? And I think we built that. It's a corporate finance problem, but in some ways it's not that hard. We fail big corporate organizations all the time, and that doesn't destroy the economy overnight. We've even gone through waves where industries, like the airline industry, have gone through a lot of restructurings, and the airplanes keep flying. So we know how to do this in some industries. We just never really thought hard enough about how to do that in banking. We should have. The phrase too big to fail was coined with Continental Illinois back in the late 70s, early 80s. And it's sort of shame on us that we didn't invest in fixing that problem until we had to in 2008. But today we have resolution powers. We have the ability to stay runs, and we have $1 trillion of reserve capital that is held by individual banks and can be turned into equity if need be. So those are huge powers that we didn't have in 2008. And in a way, because the corporate finance is not that complicated when you boil it down, I have a high confidence that that will be effective.
So, working in the private sector, do you think the private sector could make better use of topics coming from academia? And either way, what topics would be most useful for you? What should academics be working on?
So it's a great question. A lot of the topics that we talked about today were the interaction of the private sector and the regulatory sector. And so one of the things I wanted to encourage people to work on was more dynamic models of the economy. So for example, we talk about optimal capital levels for banks or optimum liquidity levels. Optimal for what? The economy goes through cycles. What's optimal at the top of a cycle and the bottom of a cycle are probably different. If you don't have a responsive system, you may end up creating more problems than you solve. So I think if academics can work more on how do we build a system that has good properties through a cycle and thinks about, for example, how should buffers move as we go from boom to bust? How should they move across borders? I think about buffers both in terms of liquidity and capital. How do we adjust stress tests to do similar things? I haven't seen very much work on that. I think that's hugely important because right now we've generally used those levers to build up reserves in the system. But if banks don't have the ability to dip into those buffers, then I worry the next recession we will cut off credit harder than we did before, and that will be bad for regular Americans. So thinking about how we adjust that through time I think will be important. I think it's also particularly important now that monetary policy has more constraints. We don't have the ability to cut rates 400 basis points because rates are already pretty low. So I think that with monetary policy less potent, thinking about how we use supervisory policy will become a lot more important. So I think that would be great for academics to work on.
Yeah.
One other item I think that I would throw on that list, which is present now, we talk a lot about systemic risk. And in fact, there are charges on banks for who's more systemically risky, and there's a tailoring exercise going on now at the Federal Reserve to try and triage banks into buckets of higher or lower systemic risk. But I don't think we know much about systemic risk. And when I look at those factors, they're not terrible factors, but they don't seem to have deep research behind them. I know there's been some people like Bob Engel at NYU and others that have tried to get at that problem. But I think there's a lot more work that can and should be done to sort of figure out, well, what do we mean by systemic risk? Hugely important. We have a lot of data now. We just ran a big experiment in 2008. How do we think about this better? I think we can use some help from academics on that.
Yeah, we certainly can. So most academics have never worked in industry. What do you think we don't know about financial markets that we should, about how things really work in the real world?
It's a great question. There are a couple places where I've run into assumptions from academics, and sometimes even assumptions from regulators, that turn out to be focusing on a headline issue, but not actually the constraint that banks operate under. So for example, there's been a lot of papers written around the LCR and liquidity.
LCR?
It's the liquidity coverage ratio. So it's a measure of how much super liquid assets you have on your balance sheet versus short-dated liabilities. And you want to make sure you have enough of the really liquid assets like treasury bills to make sure that if there's a small run on your liabilities, that you can handle that for, I think the period is, make sure that you've got plenty to cover a 30-day, very hard, very steep run. So a lot of people have focused on what does that system look like. There are, for many banks, LCR is an important ratio to publish, but it's not the constraint that we operate under. So understanding constraints like the resolution liquidity requirements or the cross-border nature of liquidity are the actual constraints that banks face. So if you're trying to model behavior and things about effects on markets based on the headline ratio, when the actual constraints are coming from some other things, I think that you run into those types of problems not infrequently in academia, because they don't sit there in the Treasury meetings and the CFO meetings saying, here's what we're managing to, here's the gating constraint. I think Randy Quarles said we have something like 28 capital constraints now. So it's a hard problem for academics to keep up with. So which one are the ones that matter? But I do think that if academics spend a little more time talking to bankers about how do these forest of constraints really bind you, what's really going to drive behavior, they'll get better answers in terms of macroeconomic response, how banks really behave, and have a more realistic model of the financial system.
We should do some sort of exchange.
I think that'd be great.
So is there anything else you want to talk about?
I guess the only other topic that I've been personally doing a lot of work on lately has been some of the international cooperation aspects. So one of the things that we did well in the crisis, if you look at the Pittsburgh summit of the G20 leaders in 2009, they pledged to work together and largely, I think, really tried to work together to to not play bigger than neighbor games, but to try and work together to get us all out of this serious financial crisis and big recession. As we've looked at the forest of regulation that's been built up by the FSB and individual countries, one of the things that's emerged has been a lot more regulatory trapping. Has in a sense been almost a regulatory run on national parts of the banking system. I think there's a famous quote by Mervyn King where he said, banks live internationally but they die locally. And a number of regulators have said, well, that means I must take care of my own borders and make sure that I trap capital, trap liquidity here, that I can get control of the operations of XYZ bank here. I'm not going to rely on cooperation anymore. I'm not going to trust that so-and-so is going to come to my aid later on. And so that has led to a lot of hoarding of resources, trapping of resources. And I think that makes the international system a lot more brittle. I think there are ways out of that. I think it's a place where some FSB leadership in Basel, the Financial Stability Board work in Basel could very helpfully go after that and develop better rules of the road. Because if we have nations competing for more of a slice of somebody's resources in the next crisis, I'm worried that that's more of a scrum than an orderly situation, and it won't have the positive effects that we had out of the Pittsburgh summit. So I think it's something also I think academics could work on as well. What are the game theory mechanisms that encourage better behavior? We've written on some parts of that and some ideas of what we think could work better. And interestingly enough, it turns that the cross-border features and the time dynamics, the recession versus recovery dynamics of financial regulations are deeply related. So I think there's some interesting places to go with that. But I think that's a place where we need a lot more attention both from academics and from the regulatory world.
It's a hard problem.
It's a hard problem, but it's a fun problem. That's the good part. I mean, prisoner's dilemmas, people have made some good progress on, and you know, banks are hard, but they're not that hard. Not for some of the fancy degrees I've seen in the room today, for example.
Yeah, well, we get to make a lot of assumptions. It makes
Exactly.
it easier. We only did one capital constraint, not 28.
Mm-hmm. Yeah.
Well, thank you very much. This has been fun.
Okay, thank you. Pleasure.